What's going on? In this video, we're going to discuss how to qualify for an investment loan if you're looking to buy a house. Now, these are for folks that, let's say, your credit is low, or you don't have tax returns, or you don't have enough money saved to put down for a deposit on your house. We're going to discuss all three things right now. Before we get into it, hit the like and subscribe button to get more content just like this. So, the number one thing you got to realize is that there's a will, there's a way, all right? So, the first thing is that you got to understand the formula behind buying homes. What are investors looking for when they want to buy a home? Well, they're looking for a house that's a discount, something that's cheap, something that's a bargain, where they can make some money on it. So that's the first thing you got to realize. And how to do this? Well, you really want to take 25% of profit off the top for any house you want to buy. So you look at the market value of a house. Let's say all homes in that particular neighborhood sells for $300,000, right? So when the house is fully renovated, it looks pretty, got new tile, new marble, new kitchens, new bathrooms. You can sell that house for $300,000. Now, with that being said, right? How do you make money? Right? So here's what you got to do. Now that you know that, let's say this single family house can sell for $300,000, you have to take off 25% of profit for yourself. So we're going to break down the analysis on what offer to submit on a house, so therefore you can make a profit. So you're going to take away $75,000 off top. 25% of $300,000 is what? $75,000. So that leaves you with a difference of $225,000. Now, let's say the rehab on that house is $25,000. So that leaves you with a whopping $200,000. This is the offer you submit to the seller. This is how much you would pay for a single family home in that community for that particular house. Now, the next step here is, how do you qualify to purchase this house if you ain't got the credit score, if you ain't got the taxes, if you ain't got no money? Well, you're going to have to work with some partners. You're going to have to figure it out. So the first thing you got to do is you got to identify an investment bank. And it's hundreds of them. They call them hard money lenders. So within this, you have two different types of loans. The first loan is no doc, meaning no taxes. You got to put down 20% of the deposit as a deposit. The credit score got to be 660. It could be a little lower than 660. And it's an interest-only loan for the first year. So what does all this mean? It means that once the banker gives you this loan, you got 1 year to pay it back. The amount of money that you pay the banker back every single month, so that monthly payment amount you're going to pay, is not going to go towards principal. It's going to go towards the interest, which means it's going to be in the banker's pocket. The banker's about to get paid every single month on that house. Now, another good thing about this loan is that there is no prepayment penalty, meaning that within that 1 year, once you pay back the loan to the bank isn't going to charge you for paying back the loan before that 1 year. So, I mean, he's getting over anyway, because all those payments you're paying the bank is going to his pocket. So he can't charge you a penalty on top of that. Well, he can, but it wouldn't make sense. Now, that's the first type of investment loan. Now, the second type of investment loan, pretty much the same qualifications or the same things you're going to have. You're going to have a no-doc loan. Again, no taxes, no pay stub, none of that stuff. You're going to have to put down 20% still, okay? And your credit score got to be 660 or better. Sometimes it requires 680 credit score, but 660 or better is where you got to be. Now, the thing with this loan is that it's a 30-year loan, meaning that you can pay back the difference of this loan over 30 years. The caveat here is that the interest rate is going to be a little higher than the average interest rate. Right now, last I looked at the interest rates, they're like 5%, 5.5%. Right? The interest rate you're going to get from this bank probably going to be like 7%, 7.5%, which ain't bad, but it ain't the best. So that is the trade-off by taking this type of loan. Now, with this loan, though, there is a prepayment penalty, meaning that if you pay the loan back before 30 years, you're going to be charged a fee. Sometimes they charge you 3%, 2%, depending on how many years you've held the house. So that's that. Now, this is how to get past that particular obstacle. Now, if your credit's low, you're going to have to find a credit partner, right? Somebody that has a really good credit score of a 660 or better, and you gotta bring that person into the deal. Essentially, on an operating agreement that you have for that LLC when you buy that house, you got to give them 25%. Most bankers require this. Sometimes they'll say the credit partner can be 15%, but most cases it's like 25%. Now, technically, you don't necessarily need to give the credit partner 25%, but if you're being generous, I would still give them 25%, because without that credit partner, you wouldn't be able to do the deal. So yeah, the credit partner gets 25% of the profit just for signing the loan, because in the event that you do not or cannot pay back that loan, the credit partner is on the hook. He got to pay back that money, just like you got to pay it back too. So the credit partner has to be compensated in some way. Now, the last thing is about how to raise this money, or how to get the deposit amount of 20% of a home that costs, let's say, $300,000. That's a lot of money, right? So you got to raise the money. But going back to my last formula, which is, if you know the formula, then you can present that to an investor. And you can tell that investor, look, you're going to make, 25% return on your money. Here's how I'm going to make sure that the money gets back to you. You got to understand that formula, know your formula. Also within that, you got to know your carrying costs, you got to know your rehab budget, you got to know every single cost that goes into purchasing this house, renovating this house, and selling the house. You got to put that down in an Excel spreadsheet so you know all those different costs. Then you can present that to the investor. Okay? And how do you find these investors? Well, you got to go to meetups, you got to go to real estate events, you got to be calling people in the industry. You got to, so that's just how to do it. Also, you can just tap into your family and friends and see if they have some money and see if they're willing to do a deal with you. So this is essentially how to do it. This is essentially how to qualify for an investment loan. And I got more videos coming your way. So until the next time, I'll see you soon. Peace and love.